on the day. So good evening, today's eminent faculty, CA Manoj Fadnis sir, our beloved Central Council member CA CV Chitale sir, and all the participants on day 4 of this direct tax refresher course 22-23. Today's topic being the taxation of charitable trust and section 1023C. And the repercussions of the new Supreme Court Honorable Supreme Court judgment in New Noble's case. So before we actually head in to the actual topic, I would request CV Chitale sir, our Central Council member, to give a keynote address or the opening remarks for this session, and then we'll move on to the actual session.
Thank
Over
you.
To you, Chitale sir.
Yeah. Thank you. And it's indeed a pleasure to share dais with our former president and good friend of ours, CA Manoj Fadnis ji. Fadnis ji, I would be happy to inform you and all the audience that this direct tax refresher course was started way back in 1988-89 when I was chairman of the Pune branch. And thereafter, for all these years, the direct tax refresher was continuously taken up by the branch without any break. This time, I believe that managing committee could not do this particular course for whatever reasons. So at least I thought that since I am passionate about this course, that let us have this course virtually. And for the first time now, this direct tax course is being conducted virtually. And we are very glad that this topic, taxation of charitable trust, where the trustees are given more uncharitable treatment, needs disposition. Particularly the Finance Act 2022 has made amendments where expenditure is allowed only on cash basis. Even last year, in the month of September or October, we had 2 judgments which have shattered this field of charitable institutions in the form of Ahmedabad Urban Development Corporation Limited, as well as Noble Education Society. In fact, in case of Noble Education Society, when they say that you should exist solely for the purpose of charity and solely for the purpose of education, because that was under section 1023C. And subsequently, there was council meeting. So I also invited attention of the examination committee that maybe institute, while conducting examination, is not having its own infrastructure. We are taking help of all colleges and schools for the purpose of examination halls. Now, if those schools and colleges follow the judgment of this noble education, then maybe it would be difficult for ICI as well as many other such institutions even to conduct examinations, because the schools and colleges enjoying exemption under 2023C would not be able to give it on rent. They will have to move to 11 section. But then ultimately we have to explain the government that they are playing the role, they are doing the work which the government otherwise should have done. And then for Chartered Accountants Fraternity, because after this judgment and after the changes in the Finance Act, the charitable trust field requires substantial advice. In fact, this cash basis of accounting was applicable from the financial year 22-23 itself. Last year, it's assessment year 22-23 itself. And therefore, it created much uproar. There was some printing error in some publications. So Direct Tax Committee also came out with announcement that these changes are applicable from assessment year 22-23. And they're relying on those publications. People said that there is some error in the announcement of DTC. But ultimately, they realized that TTC has clarified the doubt rather than creating the confusion. So in this background, it is indeed a great honor that President Manoj Fadnis ji has joined for the purpose of enlightening us on this particular session. And I'm happy that the audience would be benefited with his rich experience. I'm sure that if you have any queries, maybe you can put in chat box and the coordinator can certainly ask those queries to the speaker. With this, once again, I welcome Manoj ji, and over to you, Pranav. Thank you.
Thank you so much, Chitale sir. Before we move on to the actual webinar, I would like to formally introduce our beloved past president, CA Manoj Fadnis sir. It's indeed a pleasure for the Pune branch, as well as the entire managing committee to have you on this topic, sir. So I'll just formally introduce. I think Manoj Fadnis sir needs no introduction, but I'll be failing in my duty if I don't do so. So I'll introduce. CA Manoj Fadnis sir is a past president of the Institute of Chartered Accountants of India, which is a statutory body enacted under the Act of Parliament. He's also been a past president of the Confederation of Asian and Pacific Accountants, that is CAPA, a regional international organization of 32 professional institutes from 23 countries across Asia and Pacific region. He was elected as a president of the ICAI for the year financial year 2015-2016, and also was the vice president of ICAI for the year 2014-15. He was also a non-executive director of the IRDA, that is Insurance and Regulatory Development Authority of India. Also, he is a member of the National Directors Advisory Committee for the Central Board of Advisory Committee. He was also a member of the Company Law Committee set up by the Ministry of Corporate Affairs in 2015 for the amendments required into the Companies Act 2013. And based on his report submitted by the committee, the Companies Amendment Act 2017 has been passed. Also on 2017, Federation of Asian and Pacific Accountant for the term of 2 years. He has been on the he has been the board member since February 2015. He's also been elected as deputy president from November 15 to November 17. He has served as a chairman of Public Sector Financial Management Committee, PSMFC of CAPA from November 15 to November 17. He has also been nominated as a member of a Small and Medium Practitioners Committee, SMPC, of International Federation of Accountants, IFAC, for the term January 2016 and to December 28. He has also been nominated on B20 for the year 2018. B20 is a business group formed under G20 based on the Buenos Aires, Argentina. Presently, he is the independent director on the board of Federal Bank and serves as a chairman of Audit Committee. He is also on the board of other listed and non-listed companies. He was also nominated by Ministry of Corporate Affairs, Government of India, as director on the board of 2 companies during 2009 to 2012. He was a non-executive chairman of MP Stock Exchange between 2012 to 2014. He holds a degree of course, the FCA as well as BCom and the DSA. He has specialization in corporate accounting and reporting standards and direct taxes, corporate laws, and a Foreign Exchange Management Act. He has presented more than 1,000 technical papers in various seminars and conferences within India and internationally. Welcome you, sir, and it's indeed a pleasure for us to get the knowledge from your side on this very, I would say, a dynamic topic right now. So welcome you, sir. The dais is yours.
Thank you very much, CA Pranav Apte, our very respected Central Council member and chairman of the Direct Tax Committee, CA Chandrasekhar Chitresdi, our coordinator for this webinar, the treasurer of the branch, CA Pranav Apte, and all distinguished friends who have joined this webinar. Indeed, I'm thankful to the chairman, Direct Tax Committee and Pune branch for this opportunity to discuss some of the salient aspects relating to charitable trusts. Our distinguished Central Council member has given a very good introduction to the subject, brought out the important amendments which have been carried out and the implications of the decisions which he referred to. So in my presentation, I would be covering these matters and discuss some of the implications arising therefrom, as the Honorable Council member has mentioned with respect to institute conducting exams. There could be implications for schools, colleges, which give us the premises to carry out our exams. They could run into difficulty if the recent decisions of Honorable Supreme Court are applied in their full vigor. So be that discuss some of these aspects. Charitable charitable activity that many a times they do not give the kind of importance which is required to be given for the taxation aspect of the charitable. Also, many of the times, the professional work being handled by chartered accountants and tax consultants of charitable entities is also considered to be a charitable activity for the chartered accountant. Whereas I would believe this is one of the most professional activity where a little negligence or oversight could lead to very serious consequences for the trust and the trustees. So therefore, it may sound odd, but I would believe that if one is rendering professional services to charitable trusts, either you consider it as completely a charitable activity and take into consideration that you're doing it as a gesture to the society and don't charge any professional. Or if you're doing it professionally, make sure that you charge right amount of professional fees, because the kind of amendments which have taken place would require the consultants and chartered accountants and auditors auditing the entities to be very mindful of these changes and devote whatever is the appropriate time required in these matters. So with that background, let me start my presentation. Pranavji, do help me with, in case my screen is not visible at any point of time or my
Surely,
voice
sir.
is not clear. I would also keep in mind what the chairman of our direct tax committee mentioned, that there could be queries raised and put in the chat box. So if there are queries which come in the chat box, please help me with those queries so that we can discuss those queries at that point of time itself, or maybe take up at the end of the webinar in whatever manner it is considered appropriate.
Surely, sir. Surely.
So, friends, charitable trusts is a large topic, and in a webinar, it is not possible to discuss all the aspects relating to taxation of charitable trusts. So what I've tried to do is essentially focus on what are the new changes proposed in the Finance Bill 2023 and discuss those important changes which have been brought out by Finance Act 2022. Finance Act 2022, as our Honorable Chairman of the Direct Tax Committee mentioned, has brought in far-reaching changes. And it would be appropriate to discuss those changes because the kind of impact they would have with respect to the taxation of the charitable institutions. Also, in the year 2022, we had two important decisions of Ahmedabad Urban Development and Noble Education Society. These are landmark decisions. Landmark decisions as they unsettled some of the earlier decisions of the Honorable, and they have explained the concept of what is in 1023C, education institutions existing solely for education and not for the purpose of profit. So the earlier discussion with respect to predominant objects is now done away with. What had held for a very long period of time, which was decided in the case of Surat Silk Association. The Honorable Supreme Court's decision with respect to Surat Silk Association is no longer a good law as in context of 1023C6 because of the words used in this particular section, solely for education and not for the purpose. These words have been explained in great detail. So it requires us, because most of the educational institutions would be covered under 1023C6. Given that kind of a scenario, educational institutions will have to be very careful to see what are the other activities which they have been carrying on along with education, and whether they could still continue those activities in the given the fact that the new law has been pronounced by the Honorable Supreme Court. Fortunately, the decision of Noble Education Society, the Honorable Apex Court has clarified that it will operate prospectively. So, considering it to be having been pronounced in the financial year 22-23, I would assume that this would be applicable from financial year 22-23, that is assessment year 23-24. And therefore, it would be appropriate for us to look into the objects of the educational institutions and see if any correction is required to be done. And whatever is required to be done needs to be done before the end of the financial year. So with that background, let me first come to some of the important provisions, the way I look at this law, the way the taxation of charitable trusts is being looked at under the law as pronounced by the honorable courts and arising out of the recent events. So this slide, I've just tried to cover what are the sources from which the funds are raised and how those funds are then applied for the charitable purposes. Hitherto, what was important was the application part and whether the application was in relation to the objects of the trust. So far, so much importance was not being given as to what is the source from this application, so long as the application was done for the objects of the trust. So the application of the funds could come from, let's say, corpus donations, voluntary contributions, and income arising in the hands of the charitable institute, which could be the various heads which I have mentioned here, surplus of the previous years, loans and borrowings, and there could be creditors, trade payables, etc., which could be a source of fund from which the application towards the charitable objectives is carried out. Now, what happens is, as the law stands today, it is what is in serial number 2 and serial number 3. That is what is required to be seen as to whether the money which is received on account of voluntary contributions or what is an income of the society or the trust, how that has been applied towards the objects of the trust. So if it is a corpus donation which is received, or it is surplus of the earlier years, or it is loans or borrowings, or it is any kinds of credits, current liabilities, trade payables, they would not be considered. As I said, the emphasis was on the basis of what is the real income or the income as understood in the commercial context. And therefore, even if there was a surplus of the previous year, as long as it was utilized towards the objects of the trust, it was considered as a valid application. But now what is being brought in by the law and the way the law is being administered is that it is Income Tax Act. It is taxing the income. It is not an expenditure tax which is looking at, which should look at the application, how the expenditure has been carried out. And therefore, the application, both for the application, what is required to be seen is the application should be arising from the income of the trust. So if there is a corpus donation, in simple words, corpus donation is exempt. It is a capital receipt, provided the conditions prescribed under 11(1)(d) are complied with. This is not a taxable receipt. So if there is an application from corpus donation, since the income is exempt, any application of that income is also not to be considered while computing that 85% which is required to be spent out of the income of that year. And similarly, if there is a surplus of the earlier years, the surplus would normally represent that 15% limit up to which the income is not taxable. And therefore, if it was exempt in the earlier years, the question which the department and the law today is asking is, if that surplus was exempt in the earlier years because it met within the definition of that 15%, the quantum of 15%, which is exempt in the 11(1)(a), and if that surplus is now being used for the purposes of application, that quantum will not be considered for the purposes of. So what it really arises is that one has to be very careful about what is the application and what is the source of that application. To the extent there are voluntary contributions received, and income, which could be in any form. It could be receipts from main objects, receipts from incidental objects, or any other property which is property held under the trust. That income would be considered, and 85% of that income is what is required to be spent towards the objects of the trust. So this is one aspect which has become very clear. So if there are loans, if there are borrowings, then now onwards, those loans and borrowings would not be considered for the. In context of loans borrowed earlier years, where that application was considered as an application, or if there are loans borrowed now and which has been utilized for the purposes of objects of the trust, when that borrowings are being repaid, that repayment of borrowings would be considered as an application. So in that context, the accounting of the trusts assumes very great importance. And this kind of a linkage about what is the source of income and how it has been applied needs to be very carefully seen to arrive at what is the income which is exempt in context of Section 11. So Finance Act 2022 brought in very clearly that we have two tax regimes. A regime under Section 1023C, earlier it was Section 1023, now it is 1023C, up to clause 6 and 7, and then there are 21 provisos to that section. And what is contained in Section 11, subject to compliance with the conditions prescribed in Section 12AA, AP, and Section 30. Now, the term charitable purpose, which is defined in Section 2, subsection 15, is what is the underlying definition, be it the first regime or the second. And it was observed that there were a lot of discrepancies or differences between the first regime and the second. To give a small example, under Section 1023C, one could accumulate the income, and that accumulation was for a period of 5 years. Whereas when it came to Section 11, under subsection 2 of Section 11, when the income is, that accumulation was under Section 13, was effectively for a period of 6 years. Because the subsection 3 of Section 13 said that if the money so accumulated is not spent in a period of 5 years or in the following year, then it becomes an income of the trust. That is, it becomes taxable. So effectively, there was a period of 6 years which was available to a trust registered under Section 12AA, enjoying exemptions under Section 11(2). Whereas under 1023C, it was limited to a period of 5 years. Besides this, there were some other anomalies between the first regime and the second regime. And those anomalies have now been aligned, and they have been, in a way, the provisions appear to be similar, be it a trust or educational institution enjoying benefits under Section 11 or under 1023C6. But I noticed that under 1023C6, as we will discuss the decision of Global Education Society, the Honorable Supreme Court has brought out that it is in relation to the wordings in section 1023 clause 6 is an institute or a university engaged solely for the purpose of education and not for. So while section 215 defines charitable purpose, it includes relief to the poor, medical, education, yoga, preservation of monuments, and other charitable purpose involving general public utility. Whereas under 1023(6), all these clauses of section 215 are not, and it is solely for education and not for the purpose of profit. So both the things are important. Now, assuming the educational institution is also rendering relief to the poor,
Sir,
then can it be?
So sorry to interrupt. Some of the participants are saying that your voice is little low. So can we just little raise the voice, or we can check up the settings?
Okay. Voice is low. So friends, I hope now you can, I'll increase my pitch of the voice so that my voice is loud and clear.
Yes, it is clear now.
What I'm trying to bring out is under 1023(c)(6), as I said, only education, solely for education and not for purpose of profit. So if an educational institution is also rendering medical relief to the poor, medical relief, helping poor, preservation of monuments, which are objects covered under section 215, then it will not be existing solely for education. It may not be for the purpose of profit, but it is not solely education. So these are aspects which need to be considered in light of the recent decision of the Apex Court. Now, if an education institution is solely for education and not for profit, then the incidental activities which are carried out by that educational institution need to be examined very carefully in light of the recent decision. So while the tax regimes under the first regime and second regime have been aligned, trusts registered, educational institutions registered under section 12AA, having exemption under section 11, they are not necessarily only for education. Whereas under 1023(c)(6), it is solely for education. So what I mean to say is that arising from the recent decisions, even now there are differences which exist between the first regime and the second regime. And therefore, a very careful decision needs to be taken in case of a new institution, new trust, whether to go for section 12AA or to go for section 1023(c)(6). So these are aspects which will have to be considered going forward. In this year's memorandum to the finance bill, I saw a very nice compilation which the government has done, bringing out all the conditions which are there currently with respect to application for what are the rules which are to be considered for the purpose of application of income. So, and this I have picked up from the memorandum explaining the finance bill. Very nicely, all these conditions have been summarized, and these are the conditions which are common under both the tax regimes. And this is what was achieved by Finance Act 2022. So the first is that the application should not be in the form of corpus donations to another trust. If it is a donation which is in the nature of corpus donation, then that application will not be considered as application of income for the purposes of claiming exemption. Second is what are the provisions which are contained in section 40A1, 1A, where there is an expenditure which is disallowed if the appropriate tax is not deducted at source, or in context of section 40A3, where payments other than account pay checks or the prescribed online modes, if payments are made in contraventions of the accepted provisions, then there is a disallowance which is carried out. Now, these provisions have also been made applicable in context of computing the income which is exempt for charitable trusts. We need to be mindful of the fact that charitable trusts computation is not basis the heads of income. Heads of income is under section 14. 14 gives the heads of income. And charitable trusts and educational institutions are covered, either their computation is under section 11 or under section 1023C. So directly the provisions of 48.3 and 40A1 are not applicable insofar as charitable institutions are covered. But now they have been made specifically applicable by way of the amendments in section 11 and section 1023C. Then carry forward and set off of excess application is not. So as I mentioned earlier, if there is a loss of the earlier years and I have a surplus in the current year, can I say that this year's loss is adjusted against last year's application, last year's losses? Carry forward and set off losses. The department's view was that carry forward and set off of losses is covered under section 72, which is not applicable for charitable trusts. And therefore, income of this year cannot be said to have been applied against the excess application of the previous years. So just to give an example, in year one, my income is say 100 and I have spent 140. So I have a loss of 40. In year two, I have again an income of 100 and I spend only 60. And I say the balance 40 is to recoup the losses which I've incurred in the previous year. So over a period of 2 years, my income is 200, my expenditure is 200. And therefore, the contention of the SSC was that the loss of the earlier year can be set off against the income of the subsequent. Honorable High Court of Rajasthan had decided in favor of the SSC. There is also a favorable decision from Madhya Pradesh High Court Indore bench on the same issue. However, the law is now amended. The amended law specifically states that carry forward and set off of excess application will not be considered as an application of the current year's income. So there is a departure from what was the concept of income as computed under the normal commercial principles, which was the guiding force for computing the taxable income for charitable trusts. So that has been done away by virtue of these amendments, which are applicable in case of both the regimes. So whatever loss is incurred in the year one will not, that excess spent in year one will not be available for set off against the income of the subsequent year. And the income of the subsequent year again has to be spent to the extent of 85%. Otherwise, that excess would suffer taxation in the second year. Then, as our Honorable Chairman mentioned, application is now allowed on a cash basis. But this actually brings in a hybrid method of accounting or computation on a hybrid basis for the purposes of charity. Starting from assessment year 22-23, financial year 21-22, and as the Honorable Chairman rightly mentioned, the Direct Tax Committee clarified, whereas some of the leading tax publications had committed an error in terms of saying that this provision is applicable from assessment year 23-24, whereas this was applicable from assessment year 22-23 itself. And thanks to the chairman and the committee, this was very appropriately clarified by our institute. So what happens now is, either in case of smaller trusts, it could be useful to follow cash method of accounting. So the receipts are on cash basis, the expenditure has to be on cash basis. But larger organizations, charitable institutions enacted under Section 25 and Section 8 of the Companies Act, where following the mercantile method is mandatory under the respective laws, under the Companies Act. For them, it is going to be a difficult proposition. As the income, the receipts are to be considered on accrual basis, but the expenditure will be allowed only on cash basis. And the provisions which are there in Section 43B, that if the expenditure is incurred up to the due date of filing of the return of income, that expenditure is considered as deduction. Unfortunately, those provisions are not applicable in context of charitable educational institutions. So the expenditure will be considered only on cash basis. So March 22, what we had done was to see that what are the sundry creditors outstanding on 31st of March 2022. And if they pertained to the financial year 21-22, to that extent, the expenditure was not considered as an application. If they pertained to the period before 31st of March 21, then they had already been considered as an application in the earlier years and they were not required to be disallowed. It is only the expenditure which was incurred in the financial year 21-22 and the payment was not made up to 31st of March 2022, they were required to be disallowed. Now, for the financial year 22-23, one will have to see what is the amount which is incurred during 22-23 and what was the payment made in the last year will be added and what are the sundry creditors at the end of the year will have to be reduced. So the working will have to be more, will require from financial year 22-23 to adjust the opening creditors and closing creditors to arrive at what is the net cash paid for the expenditure which is incurred. And therefore the payment will be considered only on the cash basis. Then the charitable trusts have to ensure that the property held under the trust is not being used for the benefits of persons who are the managers of that trust or who have directly control over those trusts. So it could be the settlers, the trustees, the relatives as prescribed under the provisions of Section 13, and which provisions have been brought in even under the first tax regime under Section 1023C. And to the extent the charitable trusts have applied their property to the benefit of the trustees or their relatives, to that extent, the expenditure will not be considered as an application for which is exempt under the Income Tax Act, and therefore on that, to that extent, the income will be taxable. So if a trust is running a hospital and it charges lower rate of fees for a trustee or a relative of a trustee than what it is charging to a normal patient, then it could amount to a benefit being conferred on a person which is hit by the provisions of Section. So this is one aspect, because as chartered accountants, when we carry out the audit, we are required to look into this matter. And it would be guided by what kind of internal controls the institution has, depending on the size of the institution. If it is a small educational society or a small hospital, it will not be difficult to identify these benefits. But in context of larger educational institutions and larger organizations, these are aspects which will depend on what kind of internal control framework which exists and how the entity first ensures that if there is a benefit being given to a trustee or a relative, how it is being captured and how it is being ensured that the payments are being properly collected from the concerned person. I see somebody raising a hand. So, Pranav, you may consider muting that person. If there's a question, we can.
Yes. There is one question which says, is separate registration required under Income Tax Act to file a return under 1023C Roman 4 if 50% of the income in the form of government grants, that is more than 50% of the income is in the form of government grants. Can such ITR 7 be filed without 12A registration? So three conditions they are saying that income greater than 50% is in the form of government grants. Then whether ITR 7 is to be filed, but they are not having any 12A registration. And under this, probably they are filing the return under 1023C Roman 4, substantial finance from the central or the state government.
It is so educational institutions, if I remember correctly, it was under 1023C3AB, which are wholly and substantially financed by government. They are exempt. But when you say they are wholly and substantially financed, there were earlier a lot of litigation on this issue as to what is substantially financed. There are decisions which said it should be 75% government grants. And there were decisions which said that even 51% is good enough. So there was litigation on this issue. And somewhere in 2014, the rule was inserted which laid out the conditions which our CA Pranav just mentioned, that it should be at least 51% should be financed by the government. Now, if a benefit is if a society or a trust is taking the benefit under 1023C, under those provisos, it is better to be registered. Because what could happen is in 1 year, you may have more than 51%, and in the subsequent year, you may not have more than 51%. I have dealt with a matter similar to this, where an educational institution in the earlier 8 to 10 to 15 years was getting substantial government grants, and it was 100% funded by the government. Subsequently, the percentage declined because their internal accruals and the receipts from their organizations increased. Under that background, if it is not registered under 12AA, it cannot fall back on the benefits under section 11(1) and say, I have applied my expenses to the objects of the trust, and at least if I spend 85%, I should be considered exempt under 11(1). So whichever regime one goes into, one should ensure that one is duly registered. As I said, it could be under 1023C, or it could be by way of registration under 12AA, or 12AB as the new section stands. It would be good that the entity is properly registered. Otherwise, one has the risk of losing that exemption. And so these are the 7 conditions. And the last condition, which is important, is that the application should be in India. Now, if it is outside India, then it is essential to take the approval of the Central Board of Direct Taxes under 11(1)(c) and see that subject to that the deduction the exemption is sought for. So if educational institutions which have, say, foreign tie-ups, many educational institutions have foreign tie-ups, and they have collaborations with foreign universities and foreign colleges, need to ensure that if the money is being spent outside India, that 85% what is required to be spent, that 85% should first be spent in India, and in excess of that, if it is spent outside India, then there is no difficulty. But if it is within that quantum of 85%, then certainly it should be done only with the prior approval of the CBT. So these are the changes which came in mainly by Finance Act 2022. So let us look at what are the proposals for Finance Bill 2023 in relation to charitable institutions. So as I mentioned that loans and borrowings earlier could be considered, money raised through loans and borrowings could be considered as an application of income. But subsequently, this has been amended and mainly by Finance Act 2022. And the law as it stands today is that if money is borrowed, then that money spent out of borrowed borrowings will not be considered as an application for the reasons mentioned earlier, that it is an income tax, tax on the income and not a tax on the expenditure. So the income should have been spent. If the spending is out of borrowings, that spending will not be considered as an application. So what happens is that I have say borrowed 100, I have spent that borrowings for say construction of a capital asset, and in the subsequent years I generate income and I repay those borrowings. When I'm repaying those borrowings, that repayment will now be considered as application. But up to 31st of March 2021, that is prior to the amendments brought in by Finance Bill 21, which became effective from 21-22, that borrowings would not be considered for the purposes of application. So any amount which is borrowed up to 31st of March 2021, if it is being repaid, then the proposal is that that repayment will not be considered as application, because up to March 21, whatever was borrowed and spent had already been considered as an application, and the trust will not be eligible for double deductions. Similarly, if a trust has received a corpus donation, and that corpus donation is, let us say, as I've given in this, it has put it in a fixed deposit. In the second year, part of that fixed deposit is being encashed and a capital asset is being acquired. So the acquisition of that capital asset in the year 2 is not being regarded as an application which would be eligible for exemption, because the money is spent out of corpus donation. Now in year 3, the trust has earned certain money and it wants to replenish that deposit. So when it is replenishing that deposit, to that extent, it will be considered as an application of. Now, the changes which are brought in this regard is that whatever was done up to March 21, no change would be there. So if there is a repayment of borrowings or replenishment of deposits which were used before 31st of March 2021, will not, that repayment of borrowings or replenishment of deposits will not be considered as application. Rightly so, because double deduction cannot be. This is one aspect which is more of a clarificatory amendment. If anyone had done something similar in financial year 21-22, then one may consider, and if the return of income has been filed within the time, one may consider filing an updated return also. And there could be, if say 85% has not been utilized, then one may have to look into that excess, because that excess money would be taxable under, there is a separate new section under which that excess, that deficit of below 85% would be taxable. Now there is also a timeline which is introduced. Timeline is now 5 years. So the finance bill says that you cannot have an indefinite time period whereby you can go and deposit this money. So if it is to have proper check on what amount is being spent, this period of 5 years has been inserted, is proposed to be inserted. Therefore, for that period of 5 years, the borrowings can be repaid, will be considered as application. And if any corpus donations have been used, within a period of 5 years, they can be put back in the deposits or in any of the modes prescribed under subsection 8. That could be considered as. Now, since the period of 5 years is mentioned, the trusts and institutions will have to be careful in terms of loans, borrowing loans, because many a times we have loans which could extend for 10 years, 12 years, or even more than that. I have seen in proposals in banks where the loan period is even 12 years, 15 years, because by the time the hospital is set up and it becomes functional, it starts generating profits. So it takes substantial period of time, and therefore banks liberally allow repayment period based on cash flows up to even 12 years to 15 years. Now, purely from the taxation point of view, the deduction will be available only for a period of 5 years from the borrower. So if there is a larger, say, hospital which is being set up and which is exempt, which is availing exemptions either under the first or the second regime, they will have to ensure that the cash flow planning is done in an appropriate manner, and the exemption is being restricted only up to 5 years. In the subsequent years, income which is used for the purposes of repayment of loans will not be considered as an application. Therefore, there would be a disjoint in terms of cash flows being used for the purposes of repayment of borrowings, which are not being considered as application of income. Therefore, they may suffer from taxation. So these aspects will have to be carefully considered for larger projects which are in the form of charitable trusts. Now, this is one very interesting issue which has come up. And I never really thought about it from this angle till the time this was put in the finance bill. What the law says, the finance bill says is, see, a trust has received 100 as voluntary contribution. It is required to spend 85. Now, that 85 contains, say, some donations to another trust. The other trust will also say, I am required to spend 85. And the second trust again gives certain money to a third trust. And the third trust will say, whatever I have received, I'll spend only 85%. That will be exempt. So because of this layering which is possible, the actual amount which is required to be utilized for the charitable purposes gets reduced if one looks at the number of trusts which are created. Now, this could be in a situation where one person is monitoring, say, 10 trusts, and funds are being moved from trust 1 to trust 2 to trust 3 in such a manner that the actual utilization is less. I don't know how many such cases are there, but given the fact that it has found place in the finance bill, I'm sure there could be some such cases which could have been detected by the income tax department. So what is now brought out is, whenever a donation is given to another trust, only 85% of that would be considered as application for the purposes of that 85% which is. So let us take a small example. Again, let's say I have received 100 as a voluntary contribution, and 60 is what I have given to another trust as a donation. It is not a donation for purpose, but it is a voluntary contribution given to another trust, which has objects similar to my objects. So when I give 60, what will be allowed to me as be considered as exemption will be 85% of 60, which works out to 51. Now I am required to spend out of 100 minimum amount of 85. I have given 60, and out of 60 only 51 is being considered as eligible for this computation of 85. So to reach this figure of 85, I need to spend 34 rupees more. 51 plus 34 would make it 85. My actual outflow is 60, and further outflow required is 34. So effectively, I'll be spending 94 to get that exemption of 80. Till last year, I would have given 60, and 60 would have been considered as application. So I was required to spend 25 more. So against 85 last year, this year I'm spending 94. because that 9 rupees incremental is on account of that 15% which is not considered as application. So in a way, the message is that there is a discouragement if a trust is giving to another trust. Maybe this has become more important and relevant given the fact that we have corporate social responsibilities which have been reduced. And under CSR, there are large funds which are being donated. And possibly under those CSR trusts, somebody might have planned some layering, and therefore this kind of a embargo is proposed to be brought in by way of law. So there is a clear discouragement being given if one trust is giving donations to another trust. The message is that if you are taking voluntary contributions, please ensure that you spend it yourself for the objects. Then there is a very important provisos in section 12A, subsection 2, proviso 2, 3, and 4, which are proposed to be deleted by this Finance Bill 2020. And in fact, it is sad because these were very, very considerate provisions brought in somewhere only in 2016. Yeah, again, somebody is raising hand. So, if you could help me if there's a query being asked.
Actually, 3-4 queries are there.
Okay.
Yeah. So, first query being a trust, educational trust whose 12AA registration is withdrawn. Can the said trust claim exemption under section 1023C, Roman 3A? What formalities need to be kept in mind?
See, essentially, if the trust has a registration under 12A earlier as it stood, and if it is withdrawn, the withdrawal of that registration would be on account of certain non-compliances, which are very serious. As we will see in one of the subsequent slides, that there is a procedure which is given for cancellation of registration. Cancellation is not a simple thing. So I would say that broadly, if your registration has been cancelled, you should see why that registration is cancelled. And you must work hard to see that your registration should not be cancelled. And if it is cancelled, I don't think you can jump to another regime and take benefit under the other regime. It will be very, very difficult and it would be a losing battle. So you must look at the reasons for registration and try and see that those reasons are cured properly. Otherwise, moving to another regime may not be helpful.
Okay. So another question is.
What are the other queries?
Yes. One of my clients, PAN was not given on account of other trust. Okay, the query is read like this: PAN number, rather the PAN was not given to another trust and has received a cash deposit notice for AY 1819. The order was passed in favor of his client after a lot of litigation. Now, same client has received the same notice for AY 1617. Is client required to go for some litigation process again or the submit previous orders passed? Okay, so the query is like that, cash deposit was made in AY 1819 and the PAN was not given. So the trust has received the notice, which at the various appellate forums, I guess it has been made in favor of that particular trust. Now the similar instance has happened for AY 1617. So he's asking whether the same procedure of litigation has to be followed for this year or a different, or probably we can give the same defense for AY 1819 what they have done and go ahead for the same.
So AY, if there are cash receipts, and cash receipts has been the reason for the scrutiny assessments and whatever litigation which followed for AY 1819, and if there is a similar issue for a preceding year, you may first look into whether the reopening is valid or not. So because the law relating to reopening has undergone a major change and it is restricted to 3 years. If it is beyond 3 years, then there should be a income escaping assessment of up to minimum 50 lakhs of rupees. Do you fall in that threshold? And if yes, if the reopening is valid, then of course you have to undergo the same, you'll have to bring out the same defense or whatever are the reasons for those cash deposit, whether the cash has been properly accounted in the books of accounts, and if the cash has been properly spent by the trust for the objects of the trust. All these things will have to be brought out in the assessment.
Right.
Merely because you have a favorable decision in a subsequent year does not mean that in the preceding year also you get a favorable decision. But yes, if the facts are similar, you can bring out those facts clearly and take the benefit of the subsequent year's decision in relation to your assessment year, which is today under question.
So another question is, can a trust claim benefit both under section 12AA and 1023C, Roman 3 AD, as 12AA registration is mandatory for getting the deduction under section 80G?
Now that there are very clear two regimes, and there has been a process of re-registrations for existing trusts. Trusts will not have registrations under both the regimes, number one. One of the two has to be surrendered. So this was a benefit which was available in the good old days, which has now been streamlined, and entire process of re-registration has been carried out. And as the government said, it was originally up to March 21, but it was extended right up to 22nd or 25th of November 2022. So they have said we have given substantial time to all the trusts to comply with the law, and there has to be a deadline beyond which the penal consequences will apply. So today it is not possible for a trust to have dual registrations, and just switch from one regime to another regime is not a valid proposition.
So another question is, trust is registered under 12AA. Building is being constructed for objects of the trust. The trust utilized the building fund and amount collected. There was a separate collection of amounts for the construction. The trust also utilized regular donation for the construction. What will be the implications for depreciation and utilization of donation as application of income?
So the friends, you may, I'm sorry, there may be some sound which may be coming in. It is may create some disturbance, but only thing I can say is there is a temple nearby, and if there's a prayer going on, it is also a charitable institution and helping us to understand the charitable law relating to taxation of charitable entities in a better way. So be that as may, and I regret if there is a sound problem again. But coming to this query, funds are used for construction of assets. Earlier, dual deduction was possible. That this construction is considered as an application of income, and subsequently depreciation is also claimed. So there is a direct decision of because this was subject matter of a lot of litigation, finally reached the Supreme Court, and the court held in favor of the SSC that till the time the law was amended, I think it was assessment year 16-17 from which this new law is applicable. Subsection 6 to section 11 has been inserted, which says that if you have considered the capital asset as an application in the earlier year, you cannot claim depreciation on that capital asset. So if you do not consider the construction as a capital, as an application, then yes, in the subsequent years, you can claim depreciation. So assuming the capital asset is being constructed out of borrowed money, so that borrowed money is that acquisition of that capital asset will not be considered as an application because the source is the borrowed money. But in your context, you said there is a building fund. So I presume there are some reserves available with the trust, which are being used for the purposes of construction of that capital asset. So my first slide is again very important. If you have building fund, it means accumulated income of earlier years. So that accumulated income of earlier years, which is there in the form of building fund, application of that building fund is not an exemption for the purposes of income which you have earned during the year. So acquisition of capital assets using money from building fund, acquisition of capital assets, buildings will not be considered as application in that year. But assuming you have an income this year of say 1 crore of rupees and 50 lakhs out of that is spent for construction of some building. So that 50 lakhs which is spent out of this year's income will be considered as application. If it is out of earlier years building funds, it will not be considered as application. Then if you have borrowed money, whenever you repay that borrowing within a period of 5 years, to the extent of money repaid, you will get a deduction. That will be considered as application, provided it is coming out of that year's income. Now, if the capital asset has not been considered as an application, then in the subsequent years, you can claim depreciation. And depreciation would be allowed.
Right.
Okay.
One more question was, the earlier registration of TEL, A and ATG was valid up to 30th September 23. And however, before 25th November 22, it could not be renewed. So what is the remedy now for such a trust?
So you apply for registration for the current year. For earlier years, there will be a problem. Now, this slide is exactly with respect to that.
Right.
The slide which is on the screen right now is dealing with the same issue. There was the second proviso to section 12A subsection 2. The second proviso was providing that if in a subsequent year you get a registration, you are unregistered trusts, let us say right from beginning till 2022-23. This year you realize that you should have been registered, you register yourself. And if your objects were same in the previous years, say your case was picked up for scrutiny assessment for assessment year 18-19, you were an unregistered trust. In 22, you have obtained a registration. Then, if there is no change in the objects from assessment year 18-19 to assessment year 23-24, then this registration this year would also be considered as registration for an assessment year which is pending before the assessing officer. So this is what the second proviso was. And on this issue, interestingly, there is a lot of litigation which is going on. Gujarat High Court way back in 2005 in a similar context had held in favor of the SAC. And the Gujarat High Court had said that if a matter is under litigation, if it is say before the appellate tribunal, your assessment year 18-19 has been assessed by the assessing officer. Today you are before the income tax appellate tribunal. Then Gujarat High Court said it is still considered as pending before the assessing officer. Applying the rationale of that decision, the Honorable Tribunal and Ahmedabad Tribunal in the case of this Sri Bhanushali Mitra Mandal Trust said that if the earlier year registration granted in this year, then that benefit goes back to the earlier years. Reading that second proviso to section 12A subsection. Following Ahmedabad Tribunal, even Indore Tribunal has considered the matter in favor of the SAC. I'm not aware of the position of Honorable Pune Tribunal, but one decision of a tribunal is generally being followed by the other tribunals. Unfortunately, Allahabad High Court has held differently, and therefore the decision of Allahabad High Court will now prevail over the decisions of the tribunals, because High Court is at a level higher than the honorable tribunals. Honorable Allahabad High Court in this case of Shiv Kumar Sumitra Devi Smarak Shikshan Sansthan has said that the proviso cannot change what is there in the main section. Proviso cannot be read in such a manner that it can override the section. It is a small carve out. And therefore, Honorable Allahabad High Court has, reading the decision, reading the context of that proviso, has stated that the benefit will not be available to the SSC. And the SSC went in a special leave petition on this matter before the Supreme Court. I don't know for what reasons, but this is reported as a subsequent decision of the Supreme Court that the case was withdrawn and therefore the court has dismissed the SLP. So as things stand today, it is the decision of Honorable Allahabad High Court which will prevail over Gujarat Tribunal and Indore. And to the best of my knowledge, Gujarat Tribunal decision is much before Allahabad High Court Tribunal, Allahabad High Court order, and before Honorable Indore Tribunal, the decision of Allahabad High Court was not placed before the Honorable Tribunal. The tribunal only followed the Gujarat Ahmedabad Tribunal. So the matter as of today rests on the basis of the decision of Allahabad High Court. I am given to understand that this matter is under litigation before Honorable Gujarat High Court and Supreme Court, that whichever decision is more favorable to the SSC, that should be applied. So in Maharashtra, Gujarat, of course, the decision of Gujarat High Court will prevail. But in Maharashtra, Madhya Pradesh, and in all states other than Uttar Pradesh, if there is a favorable decision, that favorable decision will prevail. But in Uttar Pradesh, the decision of Honorable Allahabad High Court will prevail. Now, in that context, what is important is, what was the reason why this proviso was brought in? The reason was, there are a number of charitable trusts in India which are doing very good charitable work. And as I said at the beginning, people who are involved in charities are so occupied in their charitable work that they do not give proper importance to the legal compliances, which is unfortunate. But that is a reality. So in 1516, this proviso was inserted just to help those trusts and get themselves registered. Okay, you were not registered in the past. You come and get yourself registered now. And if you get your registered now, to the extent you had the same objects in the earlier years, you get the benefit of exemption. That was the object. If it is inserted by way of a proviso, and that proviso is not in consonance with the law, and that is the reason why Honorable Allahabad High Court has struck down that proviso. I expect the lawmakers to create the law so that charitable trusts doing good charitable work are encouraged and are not put to difficulties. So as a friend who asked this question on this issue, if you missed the bus, you are not registered up to 25th November 2022, then you have all serious consequences arising from these amendments. And the trusts will have huge financial implications, but that is how the law will be administered. So if the law is harsh, so be that as may. I mean, it is a harsh law, but whatever is the law will have to be followed. Therefore, I mentioned that the trust's taxation is complex, is something which requires real application of mind. And unfortunately, the trustees don't give that degree of importance. In a commercial organization, people are very conscious, but in trusts, generally, they don't give so much importance to the legal process. Many, not all. And that is where the difficulty arises. If you look at that decision in case of Rasipuram Rotary Club Trust, this issue was before Honorable Madras High Court. This is some Rotary Club. Rasimpur would be some club in the state of Tamil Nadu. It received a corpus donation. It was not registered under 12AA as the law stood at that. The assessing officer said this is income under section 56(2)(5). The trust, the Rotary Club said this is a capital receipt and capital receipt is not taxable. But Honorable Madras High Court has held that if there is a provision in 56(2)(5) and which is now 56(2)(10), if you have received any property, movable or immovable as the law now stands, it is income under section 56. So even if it is a corpus donation, and if the trust is not registered, the trust will have to suffer the difficulties of section 56(10) and that income. So these are decisions which are interpreting the provisions of law, which could be said to be harsh provisions, but that is how the on this issue. And now what has been done by Finance Bill 2023 is this section 12A subsection, on the ground that we have a new procedure for registration. And under new procedure for registration, these provisions are redundant and they have to be deleted. Actually, these provisions could still be incorporated under the new provisions, new registration provisions. And these benefits should be given. So please bring this question difficult for good trusts. I mean, we are not looking at trusts which are notorious trusts. Notorious trusts will comply with all provisions of law and still do all those notorious and nefarious activities. It is all good trusts, good trustees who are put to difficulties, and that is what we should bring out in their larger interest. This amendment is going to be a very harsh for trusts who have missed registrations till 25th November. Now, this new procedure for registration, which has been introduced in the recent past, talks about provisional registration and final registration. Now, there are certain disparities in context of provisional registration and final registration. For instance, a new trust has to register provisionally before the start of the year. So if the trust is incorporated in the month of, say, February, it is good enough. The trust can wait till April. It can apply in February and March, get itself provisionally registered, and in April, it can start its activities, charitable activities. But if the trust was incorporated in the month of April 2022, then since the year has already started, it would be required to wait till April 2023 to start its charity. So these anomalies have now been addressed, appropriate procedure to that extent has been simplified, and the difficulties being faced by the trusts are proposed to be eliminated, and these are good procedural changes which are there in the. Then, friends, matters relating to violations are very serious. Now, violations in case of most of the trusts are unintentional, but even unintentional violations could be very serious. So incomplete applications, not obtaining applications, giving false information, all consequences should follow. If somebody is running a trust and giving false information, that itself proves that the objects of the trust are not clean, people are not coming with clean hands. But giving incomplete information could be accident. So incomplete information, not filling up the forms properly, could also result in cancellation. Therefore, that is where our duties as professionals become. All aspects are properly covered in that, the information given. So what happens is, in the current scenario, a trust has a registration for a maximum period of 5 years. After 5 years, again, it is renewable. The renewal has to be applied for 6 months before the end of the expiry of the registration period. So we should be very careful in whatever trusts we are handling. What is the period when that registration is getting expired? And well before 6 months, the applications need to be filed. So the department or the government in this clause has brought out a very interesting issue. Suppose a trust is registered for 5 years, and after 5 years, it does not apply for re-registration. So it says that once I am registered, I follow all the law. After 5 years, I get out of the situation, not registered. So from that year onwards, I'll start paying taxes. But the issue comes, what happens to the income which is accreted up to that date? So for all these years when I was exempt, I had 85% being spent, and therefore 100%, that 15% of my income was being exempt. I have not paid taxes. I have constructed capital assets. So to prevent a mischief, if somebody plans it like this, that for 5 years I'm registered and after that I don't renew my registration, and whatever assets I've created, then I can sell them off, distribute those assets. That is where the loophole is being. Once you are registered, there is an obligation to continue with the registration. And failure to register, to re-register, would invite the difficulties under 115 TD, where on the accreted income, 30% would be the tax which is paid. So this is a very, very serious consequence of failure to re-register. So trusts which do not register in time, they have forgotten that period of 5 years is over, and they fail to re-register in time, will have a problem, because then it could be said that failure to re-register timely, the accreted income becomes taxable at that point. So here, the suggestion which is going through other branches to the institute is that there should be some mechanism. If somebody has forgotten, if the delay is 1 day, 2 days, 1 month, 6 months, it should be curable. If a trust is doing its activities properly, it has forgotten to re-register. Subsequently, it comes to the notice of the trustees, they apply for registration. So there should be some mechanism whereby they are given the benefit of registration for that intervening period, and condonations of delay should take place in appropriate. So the law must provide for that mechanism. Today, there is no mechanism. If there is a failure to register, that failure to re-register would result in, again, taxation. So if say the registration is expiring in February, registered was say 2022 February, expiring in February 27, and the trustees come to know when they come for filing of their tax audits and tax returns in August. So by that time, the registration has expired. The year has closed. And at that point of time, the balance for that year ending March 27 would suffer taxation at the rate of 30%. So these are good provisions to plug the loopholes, but they could have very serious consequences. The other provision is alignment of these audit rules, filing of tax audit reports, and Form 10 and Form 9A. Form 9A is with respect to where the accumulation is on account of reasons that you could not spend it, or the income has accrued but not realized in cash, and therefore you have not been able to spend it. So you can file Form 9A and Form 10 if the accumulation is for that prescribed period of 5 years. In such cases, the forms could be filed before the due date of filing of the return. So due date of filing of the return is 31st October. Now it is proposed that it should be filed 2 months before that. So these forms are proposed to be filed by 31st of August. Whereas the audit reports are required to be filed by 30th of September. Now, I don't think it is possible for any trust to find out the correct amount which is to be accumulated if the audit is not complete. So in a way, what it means is that the audit report should also be completed well before 31st August. Then only the trust will be in a position to file Form 10 and 9A with the correct data. Because again, the issue would come if I filed a form, there is no specific provision in the law that it can be revised. The other argument could be that under if you file it subsequently, it should before the completion this is the due date for filing of the audit report becomes 31st, which we need to keep our trustees. Now the provisions relating to compliance of filing of returns are very strict. If the returns are not filed timely under the time prescribed under 139(1) or a belated return under 139(4), then the benefit of filing updated return will also not be available. And not only that, the exemptions would be denied if the returns are not filed in time. So compliances are very important, even if it is a small trust or a large organization. Timely compliance is what is. So these are some of the important amendments proposed with respect to charitable institutions. I have dealt with some of the amendments which have taken place by Finance Act 2022 and Finance Act 2021. Some of the other amendments which are important, which should be kept in mind is one is the requirement for maintaining books of accounts. The law was amended last year, and arising from that, there is a new rule 17AA which has been notified on 10th August 2022, which prescribes what are the books of accounts required to be maintained. And if you see this rule 17AA, and this is what is the basis for our audit for the year ending March 23, the books of accounts which are required to be maintained, records which are required to be maintained are very elaborate. And it covers not only the financial aspects, if there are projects going on, details of the projects, having permanent account number, Aadhaar number of the donors, trustees. So a lot of information is required to be kept in, has to be kept by the trusts. This rule, because it is a new rule, again, the contents need to be brought to the notice of the trustees so that proper compliance is ensured. Otherwise, audits will become difficult in the month of August and September. Also, there is now a requirement that if the books of accounts are not maintained at the registered office of the trust, then within 7 days, the assessing officer is required to be informed as to where the books of accounts are maintained. So normally a trust or an educational society will not have a registered office. What it would mean is the office which is mentioned on the purpose for the permanent account number, what address is given. Invariably, the registered office may not be the place where the books of accounts are maintained. There is an obligation on the trust to ensure that they inform the assessing officer within a period of 7 days. In most of the cases, this period of 7 days has already passed by. But it is still better to inform them even today that the books of accounts are not maintained at the registered office but at some other location. And the books of accounts are required to be maintained for a period of 10 years. As auditors, we are required to maintain our audit files for 7 years. But if we are auditors for trusts, it is desirable that we also maintain the audit evidence for 10 years, because that is the period for which the accounts of the trust are being verified. And if we are called upon for any kind of information, it is better that we are well prepared. Other view, legal view could be that keep the audit evidence for 7 years and not for 10 years, and why get into difficulties for the remaining 3 years. That is a view which legally one can take, but as an auditor, my humble view would be that it is better to ensure that books of our audit files are maintained for the period. Then procedure for cancellation of registration, as I mentioned earlier, is now prescribed, and subsection 4 has been inserted. It provides the various reasons when a trust registration can be cancelled. Cancellation of registration is not a simple job. And therefore, I mentioned that if the registration is cancelled, I don't think one could jump to other regime and take registration under the other regime or benefits under other regimes, because the reason for cancellation could be, could at the same time result in not getting you the exemption under the other regime. The accumulation is now restricted to 5 years. Earlier, it was 5 plus 1 year under section 11. 1023C, it was 5 years, and the two have been aligned, and it is 5 years. Now, under institutions registered at 1023C were not required to file a Form 10. It was only a requirement for those which were availing exemption under 11, section 11. Now, Form 10 has been notified even for institutions which are covered under 1023C, and this is a new requirement from this year onwards. So the different positions when the consequences of accumulations are not complied with, in the respective years, the income would be taxable. So assuming that the income is required to be deposited under the modes prescribed under section 11.5, and in the subsequent year that it is not so invested, then from that year, the accumulation will become taxable. So it is not necessarily a period of 5 years. If the compliance is not made even in the earlier period, in the earlier period also, the accumulation could become deemed in. The payments to specified persons is covered under section 13, is also covered now for 1023C by insertion of this 21st proviso. And there is a new section which is inserted 271AAE, which prescribes penalty if the benefits are given to related parties. So in the first year, it is 100%, and in the subsequent year, it becomes 200% of that benefit. And this is notwithstanding any other penalty which could be imposed. So this is one penalty. Other consequences could also follow if benefits are granted to the related. So other alignments there. We come to the substantive part. 115 BBI is a new section which is inserted by Finance Act 2022. It provides for taxation at the rate of 30%. If your expenditure application is not 85%, let's say 80%, and you are supposed to spend 85%. So that differential of 5%, which is additional savings, which if Form 10 and 9A have not been filed timely, then that additional 5% would be taxable under this new section 115 BBI at a flat rate of 30%, and no other deduction or allowances would be allowed against that income of 5%. Then there is this provision for voluntary contributions received for renovations and repairs of temples, mosques, churches, gurudwaras. Those voluntary contributions could be considered as corpus donations, provided these conditions are fulfilled and the amount is utilized, is deposited in the modes prescribed under 11.5. So these are summary of the recent amendments in the law. I would now take up those 2 or 3 decisions of the Honorable Supreme Court, which our chairman also referred to. One of the leading and landmark decision is this in the case of Ahmedabad Urban Development. And what has been this decision is clarifying is a landmark decision. It brings out very clearly that what is the concept of profit, what is the concept of general public utility, which is there under section 215. So section 215, as I mentioned earlier, covers defines charitable purposes. It includes relief to the poor, medical relief. Then it talks about education, yoga. It talks about preservation of monuments and other notified heritage sites, and any other charitable purpose which is meant for general public utility. The general public utility is where the entire litigation has taken place. Up to 2008, general public utility, the law was different, and 2008-2009, the law has undergone major change. Now, if there is a if a charitable purpose falls under general public utility, let's say as in case of Ahmedabad Urban Development or any other such development. So whether they are carrying out, whatever activities they are carrying out are in the nature of general public utility. But general public utility is proscribed by a condition that the amount which is received by way of a commercial activity, so to say, because they say trade, fee, cess, or in any other form, those receipts should not exceed 20% of the total. If it exceeds 20% of the total receipts, then that general public utility activity becomes taxable. And this is the law which has been explained at great length under this decision of Ahmedabad Urban Development. Now, take the case of a newspaper. There is one issue which was considered here, and there is a decision following that issue. Subsequently, on 31st January, the Honorable Supreme Court has pronounced its order. So, a newspaper, it is a general public utility. It has a printing press, and that printing press is carrying out some commercial activity. Now, printing press, if the receipts are less than 20%, the income of this entity will be exempt. If the receipts exceed more than 20%, then it is not falling within the definition of charitable purpose under section. So what we need to bear in mind is the two regimes which we are talking about are talking about charitable purpose. So the basic thing is that the activity should fall within the definition of 2 subsection 15, what defines charitable purpose. And therefore, if those conditions of charitable purpose are not being fulfilled, then it is not coming in any of the 2 regimes and it becomes directly taxable. So yoga, medicines, education is charitable activity. General public utility, GPU, as has been term used in this case, there the requirement of 20% has to be very strictly seen. And if the receipts exceed 20%, then in that year it is taxable. So 20% is on a year-to-year basis. I can't say that in 1 year I have complied less than 20%. Next year, if I am shooting 20%, I don't get benefit of whatever less I got in the earlier years. Each year, the receipts which are in the nature of commercial activity should strictly be below 20%. And then only these authorities are eligible for exemption. Now, one of the good things which the government has done is arising from this decision of the Honorable Supreme Court. Again, that 1046 has been introduced so that from the assessment year 24-25 and onwards, such authorities, the income of such authorities would be exempt under section 10. They don't have to fall back on the definition of charitable purpose. So all such authorities which are established under the provisions of law are entitled for exemptions for subsequent. But for the intervening period of 10 to 12 years, that litigation would still continue, and it could have been better if the law was provided in such a manner that the law is interpreted
So your voice is not audible.
litigations would continue. So this is one case law which I have covered, and I would not go through all those aspects about this. The second is in the case of servants of people's society. This is one decision which actually pained me. If you see the facts of this case, and this is a decision of the Honorable Supreme Court dated 31st January, interpreting the earlier decision in the case of Ahmedabad Development Authority. This decision is there in the case of servants of people's society. The facts of the case as they are contained in the judgment says that the SSC Society was founded in the year 1921 by the legendary freedom fighter Lala Lajpat Rai during the freedom struggle for the nation building, general awareness and welfare of the people. In 1928, the famous freedom fighter of Odisha, Sri Pandit Gopal Bandhu Das, made a will of his property, and his printing press was given to this society. Now the litigation took place for assessment year 2010-11 and 11 for 2 years. And this society, Servants of People's Society, is carrying out a lot of good activities. If you see, it is running schools in the name of Balwant Rai Mehta Vidya Bhavan in Lajpat Nagar and in Greater Kailash in Delhi, one medical college in Lajpat Nagar, old age home in Dwarka in Delhi. So a lot of good charitable activities are being done. But some of their activities are in the nature of general public. Their receipts exceeded 20%. So the court says the law is law. If your receipts are exceeding 20%, then the law has to be, then you are out of the definition of charity. When the law was first introduced in 2008, there was a ceiling of 10 lakhs. Then in 2012, they said 10 lakhs was increased to 25 lakhs. Your receipt should not exceed 25 lakhs. And in 2015-16, the limit was 10, 25 lakhs were removed, and it became 20% of the gross. So if the receipts from the printing press are more than 20%, then it is outside the definition of general. And the Honorable Apex Court has held that. In fact, so therefore this matter is remanded back to the assessing officer to look at the facts and decide in accordance with the law. So the SSC won the matter before CIT appeals, before tribunal, before Delhi High Court. The Supreme Court, it has lost out because the court said this matter was also looked into in the case of Ahmedabad Urban Development, and it has come on record that your fees is more than 20%. And if your receipts are more than 20% from commercial activities, then you are outside the purview of. So, well-established institutions are going to have difficulties in view of this decision of Honorable Supreme. So the remedy is, the larger context, the remedy for the government is to amend the law, make the law strict, so make the compliance more strict. Good trusts are differentiated from bad trusts. But for the good trusts, they should not be put to the kind of difficulty as now this trust is going to face. Servants of people's society. So financial implications would be serious, and if there's a tax liability along with interest, penalties, everything will come on their shoulders. And unfortunately, the good charitable activities could be hampered. Then the other decision which even our Honorable Chairman referred to was in the context of New Noble Education Society versus CI. This is also a landmark decision. It reverses the earlier decision in the case of Queen's Education Society and also American Hotels Lodging decisions. In this case, what has been interpreted under Section 1023C6 is education institutions solely for education and not for the purpose of. So if there is a school which is running the school and the school is having, say, income from, say, running the school buses, canteens, sale of books, they are covered as incidental activities and they could continue with the exemptions. But other activities which are being carried out by those schools, then they will not come solely for education. And other activities will have to be seen. So as I mentioned earlier, 215 covers various activities which are charitable. But 1023C6 restricts itself to one of the activity which is a charitable, which is within the definition of charitable purpose, and it is solely education. So the Honorable Apex Court has gone into detail about what is the meaning of the word solely and education. So not all they say if I go out, if I travel, I will meet more people, I will see different situations, knowledge level will increase, and that is also education. But for the purpose of income tax, what is covered in education is systematic learning. And therefore, if the educational institutions should be solely for education and not for purpose of. Earlier, the way the courts had looked at is, even if there is a profit, so long as the profit is applied to the charitable purposes, the exemptions were available. But now the emphasis is solely for education and not for the purpose of. So what is the profit which you are making? On a year-to-year basis, if you are making some surplus, there is no difficulty. But if the profit is substantially high, then the element of profit is there in the activities of the institution. It does not meet the definition of not for the purpose of profit. So educational institutions, for their coaching classes, for their other courses, they will have to bring out what is the cost and what is the fees which is being charged. If the fees charged is disproportionate to the cost, then the assessing officer has a right to scrutinize those cases and take a view that whether it is not for purpose of profit or it is for the purpose of profit. So the Honorable Court has gone into great detail and has in fact upheld the decision of Andhra High Court. In this case, the issue was there is a law under Andhra Pradesh High Court, in the state of Andhra Pradesh, that which was the unified state at the relevant point of time, where all educational institutions, charitable institutions also had to be registered under the state law of Andhra Pradesh. And in that law, there was one requirement that if your total receipts are exceeding 1 lakh of rupees, you should have something like a concurrent auditor appointed by the society's registrar of societies. So obviously, most of the institutions did not go for registration under that Andhra law, and they applied for registration only under the income tax. So in this case, the Commissioner of Income Tax said, if you are not in compliance with the state law, you are not registered in the state law, I will not grant you registration. These educational institutions took up the matter in fight before the courts and said that there is the requirement under the Income Tax Act that I should be registered under the state law. And because I am not registered under the state law, will not disentitle me from registration under the income tax. That was the issue finally before Andhra High Court, which held in favor of the department. And finally, even the Honorable Supreme Court has held in favor of the department, saying that if there is a state law, you need to respect that state law and abide by that state law. You cannot just cherry pick and choose and decide, I will comply with this law, I will not comply with that law. The institutions are required to comply with all the laws. That is how every individual is required to comply with the law as applicable to that. If the educational institution has to be registered under the state law of Andhra, they have to register. There is no choice for them. So the Honorable Supreme Court has upheld the decision of the Commissioner Income Tax in not granting registration under Section 6 to this. So the implications would be the Commissioner exemptions empowered by this decision of the Honorable Supreme Court are now entitled to scrutinize the applications more minutely, call for all audited financial statements, look at the activities before granting them. So the degree of compliance will be far more stringent in all such cases, and our jobs as professional advisors, auditors will also will have to match with what is the requirement of it. So friends, with that, I would stop my presentation, come to the end of this presentation. We are also already 8 o'clock, 5 minutes more. Any last couple of questions? Please help me with those questions. But
yes, sir.
Thank you very much to our Chairman, Direct Taxes Committee, and the excellent questions which the audience has put up, which actually makes me think over this subject and helps me to increase my knowledge. So thank you very much.
There are a few questions. One question is that telecom tower rent is income from house property. Whether 30% will be deducted from the income from property held under trust and credited to income and expenditure account, and whether can be considered as a part of 85%, or what will be the treatment for the same.
I think I didn't get your question. You are a trust which is
holding the trust has given some probably a property for telecom tower for which it is getting the rent. The trust is getting the rent.
So on the rental income, the telecom company is deducting on the rent paid, they are deducting tax at source.
Right.
So it is your income in your hands, and you need to apply to the objects of your trust.
Right. So the question is whether 30% standard deduction, whether can we claim, or only 85% of the income has to be applied. So whether it is
85% of the income will have to be spent.
Right.
Okay, I get the question now. So the computation is not under that income from house property. 85% of your income is required to be spent. Now you may say that I got only 70 and not 100 because 30% is the tax deducted at source. So you can file Form 9A and say, when I get that refund of 30%, I'll utilize it.
One more question was, assessee donated to the trust which has a provisional registration of ATG, whether assessee is eligible to get the ATG benefit.
So you are donating to a trust. The trust is provisionally registered. Mind well, if for any reasons the trust does not get the final registration, the provisional registration goes for a toss. So wait till the trust gets a final registration before you advise your assessee to give donations to that. In all fairness, if the trust gets the provisional registration is converted into a final registration, there should not be anything.
One more question which has come up is, can Commissioner allow regular registration application in Form 10AB after 6 months from the commencing the activities?
So these are due provisions, and there are strict timelines provided in these provisions. Obviously, there are no reported case laws on these matters on basis of birth, which one can say that if there is a delay, whether that delay can be condoned or not. But generally, the tribunals and courts are, if the cause for the delay can be made out, justified cause can be made out, the delay is normally Commissioner at the time of granting registration may not condone the delay. You may have to go to the tribunal if the delay.
One more question. What is the exact definition of religious purpose?
There is nothing more exact than what is given in the law.
Right.
What it really means is, like charitable purposes is defined in section 18. If the money is being spent for religious beliefs, if it is being given for, say, particular religion, temples, church, then those activities be considered religious.
Can I join, sir?
Yes.
Yes, yes, please.
Yeah. I want to ask, like, suppose the trust is canvassing the abhangs or spreading Gnaneshwar knowledge thinking. Will it be treated as a religious purpose?
So what is it promoting?
Like Gnaneshwari or social examples of Gnaneshwari means you should be good to others, you should not follow casteism.
There's a very
As given in
okay,
Gnaneshwari.
there is a very hairline difference. And there are decisions in your favor which bring out that you are not spreading the religion, you are spreading the good aspects which are promoted by the religion.
Yes.
And you are not spreading Jainism, but you are spreading, say, non-violence, you are spreading apathy and sympathy towards animals, being vegetarian, so on and so forth. So there are decisions which bring out these aspects, that whether it is expenditure incurred for the religious activities, or promoting the values enacted in that religion. So you need to put your case squarely within the corners of those decisions and see that you are not spreading Hindu religion, but you are spreading some good values arising from Gnaneshwar. That way you may consider. But one needs to be very careful in these matters, because as I said, it is a hairline difference. What is being actually done should be brought out very clearly within the framework.
Thank you, sir.
Hello. Sir, income. Hello.
Yes, please.
The bank interest which is earned, so 80% need to be spent out of that to consider as a application of income, sir?
Yes.
Okay,
Even
sir.
if you are getting 90%, only 10% is withheld by way of TDS. Out of that 90%, 85% has to be spent.
Sir, I just one very sorry to state, the other question already asked the same thing. Telecom tower, that is a trust. It is a Gurudwara on which the telecom tower is built up. Around 25 lakh rupees they are paying to the Gurudwara. Now the question is whether it is the income which is derived from the application of the trust, or it is the income from rent. Now the question, the theme line is whether it's a trust income or income from house property.
So in the hands of the trust, the computation, and assuming it is registered under 12AA and now under
Yes, sir.
12AB,
Yes, sir.
the computation is under section 11. Computation of income is not under the heads of income from house property or income from other sources or business and profession. So therefore, those deductions which are covered under income from a house property are not available. And here it will be considered as rental income.
Okay.
And therefore, out of that rental income, if you're whatever you're spending for repairs of that property would be allowed as a deduction. It is application. And whatever salaries, etc., you are paying to any staff for the
Charitable purpose.
that would be considered as application.
Okay.
And whatever are the objects of this trust, money has to be spent towards the objects of the trust, so that in totality you are spending 85% of your rental.
Yes, sir.
Though you may get net of tax say 90%, but your obligation is to spend 85%. And for some reasons, because of the TDS or interest accrued but not received in hands, bank has accrued the income, credited to your account, deducted tax, but nothing has come to your hands that you can spend. So you can file Form 9A, and the year in which you get the interest, you will spend that interest in that year is what you can make out your.
Thank you, sir. Thank you. The session was very wonderful, sir. Your speech is very wonderful. I'm very happy. Thank you, sir. Thank you.
So one more question. If income left below 2,50,000 after making all the expenditure under 85%, whether this balance below 2,50,000 is taxable, as the basic exemption limit is 2.5 lakhs.
30%.
So it will be taxed at 30%.
That new section which I referred to, 115 BBI.
BBI.
So that clearly brings out that if you are spending less than 85%, so you are supposed to accumulate 15%, you have accumulated 20%. So on that 5%, you will have to pay tax at the rate of 30%. No deductions, no allowances would be allowed. So don't look at this ceilings of 2,50,000.
So I request participants, if there are any further questions, you can put it in the question and answers box or chat box.
Thank you, sir.
So one query is, currently if corpus received is not deposited in modes specified under 11.5, then whether it shall be considered as income. And the follow-up question is, if the same is applied in the next year, whether it can be considered as application of income?
No, any corpus donation should be invested in 11.5 as one purpose. Second is, out of that corpus, if you're spending some money, that will not be considered as application, as we discussed earlier. But if you're replenishing that corpus within a period of 5 years, as the new law provides, then to that extent, the income which is applied for putting that money back into the corpus in 11.5 be considered as available for application. And for some reasons, you have ceased to provide that in 11.5. You have not even applied it for the objects, for some objects of the trust. It is not put in the deposit. Say you give money on loan to someone. So that is not the object of the trust. So to that extent, it will become taxable in that.
Another query is, the assessee is carrying on old age home activity and receiving rent from public in general. Assessee got 12A registration. So does that mean the object is of a general public utility?
So it is relief to poor, medical, education, yoga, preservation of monuments, and other charitable activities of general public utility. So you must bring your objects very clearly in one of the limbs of this definition. If you bring it in, say, relief to the poor, then it is a separate limb. But if it is not falling within the definition of relief to the poor, medical, then it is in general public utility. And in case of general public utility, you are charging fees, etc. Then your fees for old age home, if it is exceeding 20% of your receipts, then it is not a general public utility, it is a commercial.
The expenditure incurred on collection of donations, whether the same can be treated as an application of income for charitable purpose.
I think if you can bring out the nexus if the nexus of the expenditure incurred can be very closely related to the donations, then that expenditure, to the extent it should be reasonable, it should not be to a related party. So like say bank charges paid. Bank charges is what? Is the expenditure incurred in collection of the money. But if you're giving commission, say somebody gives you donation and you give commission, I don't think that would be allowed as a deduction.
One more question in terms of corpus, whether corpus amount, the donation received is used for the capital expenditure, and then whether it will be taxable as income as the same is not invested in 11.5 mode.
Yes, it is not taxable because it is used for the objects of the trust. If the corpus donation is not used for the objects of the trust, then it is to be put in 11.5. So if you get a corpus donation, you construct a hospital building, you are applying it to the objects of the trust. So that is not violation of 11.5. If the money is lying idle and you say that because I want to make the best use of money, I have invested in shares, just giving an example, that is not permitted. But you are investing the money in a fixed deposit, and as and when the construction is starting, you are liquidating the deposits and putting it for the construction. That is provided that building is being constructed in accordance with the objects of the trust, then that is fine. Then there is no difficulty.
Right. If the education institution having a receipt less than 1 crore, whether they will get a registration under Section 80G.
That, there can be a number of questions.
So I think
if educational institution, I didn't get the educational having receipts of less than 1 crore, can they get? Yes, they can get 80G registration. 80G needs, you should be registered under 12AA or 12AB now. Your object should be for charitable purposes. This is what is prescribed in 80G. So even if your receipts are, say, 1 lakh of rupees, you are eligible for exemption for getting registration.
So I think we can take the last question, then probably we can sum up. So if there are any specific queries, you can always email it to us. So we'll try to get it resolved with the permission of our today's eminent faculty. So the last question
so
is,
whatever queries come to you, you can forward it to me. I have given my mail ID on the presentation, and I'll send that presentation to you so that you can make it available to the members.
Surely, sir. Sure. The last question is read as salary to the trustees. If the genuine, if the trustees are giving the genuine and the full-time services, then whether the same.
That is one aspect which I have not discussed, because as I said, there are multiple issues in charitable trusts. Very valid issue which is raised is, if the salary is being paid to the trustee is devoting his full time for the educational institution, we can't expect the trustee to work without any salary. So the reasonability of the salary has to be established. So reasonability would be, if it is, say, educational institution, what another college would pay that person as a salary for similar kind of service. This could be something which could be considered as reasonable. Practically, I would say that if the other college pays, say, 1 lakh of rupees, pay your trustee 90,000 to be on the safe side. If he is a trustee and he has decided to do some charitable work, so let him take something less to be on the safer side. And over a period of time, the college is paying 1 lakh of rupees and you start paying him 5 lakhs of rupees, then there is going to be trouble.
That is
the reasonability test has to be established.
Right. So thank you so much, sir, for enlightening us.
Thank you very much, friends. I'm grateful to all
complex
of you for all your questions, which, as I said, increases my own understanding of the subject. Thank you so much. Jai Hind, Jai ICI.
Thank you. Thank you so much. Thank you so much, Manoj sir, as well as all the participants for participating in this direct tax refresher course. Thank you. Thank you so much.